when September ends.
Hello, welcome to the National Real Estate Post on this wonderful Monday morning. I have, of course, Barry Habib with me here once again. Before we get started, just got to make mention that Remen Flyer Paradise is still there for you brokers and even for you bankers. If you do broker, they have flyers in there about all the different loan products. You can completely brand them to yourself. It gives you something to put in your hand and take out into the field, which, based on the show we're going to have today, might be about what you need to do right about now is get out there and start shaking some hands and, bumping some gums. Yeah, kissing some babies. And anyway, the Flyer Paradise program is totally awesome. The banner's right here on your screen. It's over on your right, or it's right down below. Click it to get started, get some flyers, get out in the field. There's a link around here on Facebook somewhere as well. Now, let's get right to it. Barry, how are you?
I'm good. The bond market hasn't been behaving too well, has it?
No, and it was just last Friday. You had a post. What was it titled?
Wake me up when September ends.
Okay. Okay.
So we had done so beautifully in August. We gained in mortgage-backed security world. We gained 135 basis points during the month of August in price, which is great. And we've given all that back in September here, in just the first half of September. And really started at the very beginning of September. Yields started going up from the very first trading day. It was just trouble.
Yeah, I remember, I think it was back in May where we did that show. It was, I think it's titled The Lowest Rates Ever or something like that. It was a great show. A lot of people, a lot of feedback, a lot of views on that one. And you had predicted at that time, I'm seeing 139, on the 10-year. And take us through it. Take us from May to today, Barry. What happened?
When
Can you show us something?
The day we recorded the show, I'll show you on the chart, the day we recorded the show was over 250 on the 10-year. And when we put that out there, a lot of people were like, oh my gosh, come on, no way. And there was even some comments and thread with people were quite skeptical.
Right, yeah.
Okay, we didn't get to 139. We got to 1.42, which was
weak. Weak.
So, but people want to know, is it over, right? I mean, is it over? Have we seen the bottom? Have we seen the lows?
Yeah.
If you'd like to, we can take a quick look at the chart and take a look.
Yeah, I'd love to see it. Can you go back to where we were in May, and so we can see the whole thing?
Let's do that. Let's do that very quickly here. So the first thing I'm going to do is I'm going to show you, here is a look at the 10-year Treasury. And by the way, you can see right now as we're recording this, we're down 37 basis points in mortgage bonds. The 10-year Treasury up to 187, let's call it. Goodness gracious. Just a little over a week ago, this is at 142. And you could see that since the beginning of September, we went from that 142 low, and it has been a straight shot up. That's why we're saying waking up when September ends. And the most recent move was problematic because we broke above two important ceilings on the 10-year, the 50-day and this Fibonacci level. Unfortunately, team, we got a little more room to the upside before hitting a really, really tough, strong ceiling here that should contain us around 2%, 205. We're in a little bit of the hurt locker here. When we go back to where we were in May, let's go back to when we recorded that. And as you can see, when we go back into May, we recorded that around 250 on the 10-year.
Yeah.
Boy, it has been a wonderful move lowered, hitting 142, but we're giving some of that back now. I think we might hit this level, but I think that's going to be it. I think we'll kind of cycle back down.
Okay.
Looking at mortgage-backed securities, by the way, I just want to show you mortgage bonds just to show people what our price is based off of. It had been just a wonderful ride. And then what happened just the other day, just is now on Thursday, and you can see, we've been locking right near the top here. We locked at the top. We've done those alerts, and even on the way down, we had to do a rate lock today as we're recording this. But you can see that after breaking these floors, and this was the big one, this 50-day moving average, we're probably headed down a little bit lower. So a little bit more pain, and then maybe things start to settle down. Now, the big question that we talked about is, are we in a position of where this is over? No, I still think we're going to see a recession more than likely in 2020. I still think that rates are going to go to even lower levels. I know we talked about 1.39, even 1.37. I think we break those levels.
Really?
Yeah, I don't think we've seen the low in rates yet. There's a lot of things out there. Our debt levels are too high. Inflation, although it's ticked up a little bit, has been tame. And now this week, as we're watching this, we get the Fed. And it's really important to understand this because this could be such a pain in the butt for you guys listening to this.
Right.
What happens? The Fed's probably going to cut rates. I think they're going to cut. So the Fed cuts rates and everybody says, oh, great, I get a lower mortgage rate, right? And then adding to the pain are, the Freddie Mac reports or the reports that come out that show what was the survey for where interest rates were the previous week. Well, the rate that's live and in real time is going to be much higher than it was a week or two ago. So your customer's looking at the report that came out and said, oh, wow, I can get a much lower rate. And meanwhile, you're looking at your pricing and it's much higher. And it's caused some confusion. So a few things to note. One, the Fed funds rate that the Fed will cut has nothing to do with mortgage rates. The Fed funds rate, if they cut that, sometimes the bond market perceives that it's okay, the Fed's trying to stimulate the economy. By stimulating the economy, people spend more, people will borrow more, that creates money out of thin air and credit, and therefore it causes some pricing power, so maybe you get a little inflation, which long-term bonds like mortgages hate. That's why sometimes when the Fed cuts rates, mortgage bonds do poorly, interest rates go up. Exactly. So please be prepared for that. And you're listening to this today, you got a couple of days before the Fed meeting, get the word out there, okay, that this is something that's important to understand. Now, after the Fed comes out with their rate cut, Jerome Powell will take some questions and answers and also give a statement. If in that statement, they talk about inflation being tame, then the bond market should do okay. But if they talk about some of the concerns, like for example, one of the reasons why rates moved up a little bit recently is because we've seen a little bit of an increase in inflation. The consumer price index, that's not the Fed's favorite measure. They look at something called the PCE, or the personal consumption expenditure. I don't know why it's their favorite. It's really stupid that it's their favorite, because take into consideration out-of-pocket medical expenses or the cost of putting a roof over your head. I mean, like we don't have those expenses, right? The Fed doesn't consider those as much. They like the PCE. That's shown much lower rates of inflation. The CPI, which the market itself, traders look at, they say, this is important for really gauging inflation. That's started to move up. It's the highest level it's been, get this, Frank, in 11 years.
Wow.
So yes, so that kind of scared the bond market a little bit, because inflation, it makes things cost more over time. And if you issue a mortgage, if you issue a bond, let's say you took your own money and you lent it out. So you're getting fixed payments every month for a long period of time. Mortgage is 30 years. And what happens is inflation starts to erode the buying power of that payment. So if inflation starts to move up, it means your bond is worth less.
Right.
The only way to counterbalance that is that you have to take a higher rate, start from a higher perch to offset the increased erosion. And that's why interest rates have been edging a little bit higher. Now, I don't think this is over. I think that when I mean by over, the rally in bonds, I don't think is over, because I do think we wind up seeing a recession. We wind up seeing things slow down. We wind up seeing inflation come back down, and rates will cycle back down. Everybody wants to know, is that going to happen this week, next week? No, it takes a little time for this to flush out. It gets a little worse before it gets better, but then I do see it kind of calming down and cycling back. This is not, we're not going to see 6% mortgage rates or so. You're never going to see that again, in our lifetime at least. But we will see this bump up here, but then it should come back.
Great explanation. Fantastic. All right, man. What else I was going to ask you? I can't remember. You brought up something it just completely slipped my mind. But you know what? I'm getting to be an old man, so that happens to me.
You're not an old man. You're actually getting. You know what? You're getting more handsome.
Am I looking younger every day? Because I said that you're looking every day.
More youthful. Well, that's what Botox and hair color does for you. You know what I mean? So
I need to jump on that for sure.
Yeah.
So this is all interesting. Oh, sorry. I was just going to say, this is great stuff. Interesting. So a little bit of pain here, but overall, you still feel that it's not over, that we might still see.
It's not over, but here's the thing too, is that what we really need to do is refinances have not gone away. In fact, they'll never go away, because the big thing that I want people to miss the boat on is the individuals have equity in their home today.
Right. You
could tap into that equity and really change people's lives for the better. We've talked about this in the past, but you should revisit it. Don't despair that rates have gone up, 0.3% or so, whatever it has been, 0.25%, 0.3% in rate, and now somebody isn't saving as much on a refinance. Don't despair there, because if you pull equity out of their home, it doesn't matter what the rate is. You can go to a higher interest rate than what they currently have, but by restructuring the debt and acting as a debt manager,
still save money. Yeah.
You could save them so much money, and then take that money that you saved them, plow it back in the new mortgage, and then you reduce the term, you build equity, you change their life for the better. This is stuff that really, as advisors, we need to do. That's what we have to do right now.
All right. So thanks a lot for doing this, Barry. Appreciate being on the show always. Guys, Please check out MBS Highway. I'll put a link down below here so you can check it out. You can get it for a couple of weeks for free just to give it a try if you're not on it already.
By the way, I'm very proud of you. Saw where those locks were. Those locks were all on the very, very highs of the market. We picked the right spots to make sure you were protected and lock your clients. And I mean, look, the new loans since then, of course, pricing has deteriorated, but we were floating, and then just nailed it as far as the price peaks every time. Was really important for our subscribers to gain that.
Yeah, but you said 139 and it was 142. So.
I know.
But also I just wanted to say that, guys, keep in mind this show is recorded on Friday, last Friday. So the chart that Barry was showing you, it's a day off or a weekend off. So if you're looking at things today, might be some subtle differences, but that's because this got recorded on Friday.
We're traveling through time. We're traveling back to the future.
That's right. Hey, Barry, thanks so much for being here, man. I appreciate it.
All right. September will be over soon, team. Don't despair. Yeah. It's going to be good. It's going to be all good.
You guys have a great day. Leave us your comments down below. If you got any questions for Barry, ask. If you can get in there and answer them, you certainly will. Don't forget to try MBS Highway. There's a link down below. And we'll catch up with you guys tomorrow. So have a good one. We'll catch you later here from the National Real Estate Post. See you later.